From the Clear Channel Studios, A Professional Edge by Sean G. Todd, tax attorney, CPA, and certified financial planner, is providing general information related to taxes, investments, and estate planning. This information is not to be perceived as providing individual legal, tax, or investment advice, as each individual's circumstances are unique. Being a listener does not create an attorney/CPA or an investment advisory client relationship. Each individual's personal situation is different, and seeking one-on-one advice with a licensed professional is recommended. Securities and fee-only investment counsel is provided through Schwab Institutional Member SIPC. This is Professional Edge, a program designed to help you understand the importance of getting counsel and advice from a licensed professional and help you appreciate the significance of being able to integrate your investments, tax planning, and estate planning into one cohesive plan to prevent an unintended consequence. We will be talking with Sean G. Todd of Estate Management Counselors, LLC. Estate Management Counselors, LLC is an independent fee-only investment management firm based in Atlanta with a satellite office in Columbus, Georgia that serves select clients throughout the country. Their goal is simple: to make sure their clients feel confident and secure about their financial future. Sean is a truly qualified professional. He is a licensed tax attorney, a CPA, and certified financial planner. He is also an adjunct income tax professor at the University of Georgia. One unique thing you might not know about Sean: he attends the National Rodeo Finals each year. We will be talking with Sean.
Good morning, Chris. How are you?
Good morning, Sean. Doing well. How about yourself?
I can't complain. How was your trip?
It was great. First time flying.
Where'd you fly to?
Las Vegas, Sin City. And I gambled.
You did?
Yeah, I spent $2.
Oh, really?
And I lost $1.99. So that was my the extent. I said, if I'm going just a couple of dollars, and that was as far as I went. Had a good time.
Good.
First time flying, and really enjoyed it.
Did you make your way out to Hoover Dam?
I certainly did.
Isn't that unbelievable?
Unbelievable.
That's what America needs. Something
gorgeous.
to get our arms around, to go and build.
Oh, it was awesome. We took the tour inside and everything, and it was just unbelievable. Really had a good time with it.
Pretty unbelievable that man made that.
It is. Mm-hmm. We didn't really have a lot of time because the other stuff was going on. We had basically 3 hours from the time they dropped us off of the tour bus, and lines were long.
Right.
Trying to get through there. So we made it back to the bus with about 5 minutes to spare before they left us.
Well, that's all right.
They were waiting on us. They're like, hurry up. So it was a lot of fun. First time flying. Had a really good time with that. I was afraid I was going to be nervous.
Okay.
And I was.
You ready to go again?
Oh, definitely. After I got in the air,
yep.
I nose to the window looking out. I took more pictures on my poor iPhone than I think I've ever taken. I have 267 pictures I've taken from the time I left Atlanta until I got to Vegas and back, just on the iPhone.
That's pretty neat.
It's pretty good. I killed a battery. But yeah, it was great. Had a really good time this past week out there.
Good.
So glad to be back home, though.
Well, let's jump into it.
What you got?
All right. This week we're going to talk about investment strategies for uncertain times. Definitely there is some uncertainty with the upcoming election, with the European debt crisis, the Iran controversy. So we can hopefully help some listeners out this week to give them some strategies to increase their investment income. But last week we also talked about some observations that we're seeing in the practice. But again, Chris, got to initiate and move people off the dime to get their estate plan in order. Again, the numbers basically say 50% of all individuals out there have no estate plan in place. And if you don't have an estate plan in place, the state laws will dictate who receives your property and when.
Right.
Those are probably not the most favorable to our listeners out there. Mm-hmm. So again, call the office at 1-877-654-9798. That number again, 877-654-9798. And have Tina send you how to unlock the ultimate estate plan. It's free. It's complimentary. That will get you started to getting your estate plan in place. And a lot of listeners out there may say, well, I'm okay. I have a will. But if that will was done 5 or more years ago, definitely call in, get this, how to unlock the ultimate estate plan. You'd be surprised how many things that are not covered that need to be updated in their estate plan.
Right.
So definitely take advantage of that. But last week we looked at 7 observations that we're seeing in our practice, Chris, and these things are just coming up time and time again, and they're just underlying concepts. And the first one is sustainable income. In retirement, you want to make sure you have sustainable income. And if you are the lucky recipient of a defined benefit plan, meaning the company is going to pay you a pension for the remainder of your life and possibly a portion of that for the remainder of your surviving spouse's lifetime, then that is a sustainable income source as long as that benefit is fully funded.
Right.
So we have some risk that the pension is going to run out of assets, but hopefully that the pension guarantee fund will support that in case that happens. So that's one sustainable income source. Another one would be Social Security. Another one would be investment or interest income, but that is not a sustainable income source at the level which people started retirement with if they retired 6 years ago, because interest rates have fallen dramatically, and therefore they have less investment income coming through. And then we look and see, if you have some rental property or you may have some royalties or some dividends that come in, we look and see what is your sustainable income resource in retirement so we can plan for that. So we identify those with clients and help them manage those or even enhance those. So number 2 would be portfolio risk. That we're seeing a lot of older listeners out here in Columbus, Phoenix City. They have too much investment risk. They need to switch from being an investor to being a conservator of their assets. Because investing is taking more risk than what you should take, especially being a retiree, because you're at 70 years old, you're probably not wanting to go back in the workforce if something happens to your investment portfolio. And, some of the concentration on past winners, and we all know that, past performance is no predictor of future results. But, this used to be a great winner. And if you take a look at the hometown favorite, Aflac, a lot of our listeners out there have Aflac. And, if you look at the 5-year rate of return, it's negative. It's negative 1.3%. So, there's a difference. I like the hometown team. I think Aflac's a great company. But their stock performance over the last 5 years has not been stellar.
Right.
Do I think they're going to come back? Probably. But you got to be able to disassociate yourself from the emotional tie of I want to own the hometown company.
Exactly.
This is about investing and having a rate of return on your investments.
Right.
So we look at that, and then we look at number 3, the inflation risk. We all know as a listener out there that things are getting more expensive. Gas, bread, groceries, utilities. So is your sustainable income going to sustain inflation? So we look at that, and that's where we utilize some software in the firm, and we say if we need $3,000 per month today, what is that going to be 10 years from now at 3% inflation?
Right.
And are we going to be able to sustain our purchasing power? And that, I think, is the power of the software that we utilize. It just runs the numbers for us, so that way we can plan accordingly. Then number 4 is longevity risk that we're seeing. People don't appreciate that they're going to live as long as they're projected to. So they retire at 60, 65. Right now, they're projected to live to be 78. So that's 13 plus years in retirement. But we just got done talking with a client this week. She is approaching 30 years in retirement that her portfolio has supported her in retirement, being her pension, Social Security income, and her investment income.
It's really good.
It's really good, but that's 30 years. So therefore, you got to be sensitive to, you can't put all your eggs in the safety basket. Let's say CDs that are paying 1%. You will outlive your money.
Right.
So we look at that, and so there's longevity risk. And then we look at and see where we can assign a risk. And that would be, do you have the proper coverage on your property and casualty insurance, your homeowner's insurance, your car insurance? Make sure that you're assigning that risk at the right amounts. And no, we don't do property and casualty. We've recommended to the listeners that they definitely review their policies with their current agent. Number 6 is a long-term care risk. A lot of people say, well, I'm not going to need that, so therefore why do I need that insurance? But, the numbers say differently because there's a 1 in 2 chance that you're going to need that care. And if we run an average stay of 36 months, average cost $5,200, we're looking at about a $187,000 commitment in today's dollars. And it's not that the first spouse can't afford that care. It's what happens with the surviving spouse after that first spouse passes away. So we've taken $200,000 out of the portfolio. Now we have less assets to generate portfolio income. So therefore, the surviving spouse is put underneath a little bit of what we call financial stress. And then we look and see, how tax efficient is the client actually being.
Right.
And no, you can't run on April 15th to go to H&R Block or your tax preparer or even your CPA and say, well, I need to reduce my taxes or do some tax planning here at the very end. Mm-hmm. And the cat's out of the bag. What the listener needs to do is arrange for tax planning now, today. It's right. October. We need to sit down and see if there's anything that we need to do in 2012 before 12/31 hits for the tax plan.
Exactly.
And we look and we say, okay, is there any way to create a tax asset? That's our verbiage that we use in the practice to create that tax asset to be most tax efficient. And these are just some of the things. So if any of these raise a concern, that's where you got to reach out, give Tina a call, get on our calendar, come see us at Columbus at the Cunningham Center. That number, 877-654-9798. Be sure to stay tuned for retirement income planning.
All right, sounds good. More of the Professional Edge coming up. Keep it right here.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Sean Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Sean Todd help you implement an effective estate plan. Call 877-654-9798 today.
And welcome back to Professional Edge with Sean Todd. I'm Chris East. Hey, thank you so much for got some time this Sunday to join us for the show. A lot of good information headed your way. I want you to stay tuned with us. If you want to get in touch with Sean, 877-654-9798, 877-654-9798. Be sure to check out their website, too. There you will find a lot of info at your fingertips. Just a couple of clicks on over to emcadvisors.com.
Here we go. We're going to put on the certified financial planner hat, Chris. We're going to park the tax attorney hat and put on our planner hat.
You have a big suitcase to carry all these hats with you.
That's right.
That's how you drag it around every time you come in.
Remember, more letters after my name than in my name.
Exactly.
Right? Here we go. We're going to talk about investing for retirement income. Here's some interesting stats for our listeners out there, Chris. Since August of 2009, the S&P 500 index is up 39.6%. 39.6% since August of 2009. Mm-hmm. Been on a pretty good tear.
Yeah.
Even with the uncertainty in the marketplace. Mm-hmm. But surprisingly, over that same period in time, investors have taken from the U.S. stock mutual funds $347 billion. So the market's been going up 39.6%, and investors have been withdrawing $347 billion from the same stock mutual funds. The outflows have been consistent time and time again. Only 6 of the last 36 months have seen net inflows. 6 of the last 36. What's that telling us, Chris? There's a tremendous amount of uncertainty out in the marketplace.
Exactly.
Even though the market's been returning positive results, investors are just what they have said is stock market fatigue. So they're just done. They're cooked. They want less risky investments.
Yeah.
They see things coming. So people are, repositioning their assets to less risky investments. Here's another thing, a demographic shift. We're seeing the first group of baby boomers starting to retire, and now retirees are starting to reposition their investments so they can receive retirement income, not so much the outright growth that they're trying to attain. Again, they're changing from being an investor to being a conservator of their retirement assets. Then it's estimated right now that half of the investments in the stock funds sit in 401k or qualified accounts. That's okay, but we got to remember that you got to still manage those assets. They're not on autopilot. You need to reallocate those as the environment changes. Then when a client shifts those assets out, or a listener shifts those assets out of the stock mutual funds, where do they go? They usually sit in cash right now. Well, a 1-year CD we know is 1%, 1.01. So that's not going to get them anywhere. We have a 10-year treasury sitting at 1.72%. That says if you give me your money and put it in the treasury, they're going to give you 1.72% annualized rate of return, where inflation is running north of 2%. It's close to 3%.
Yeah.
So you're losing 1.3% safely, even in a treasury. If you leave your money in a savings and checking account, you're getting 0% rate of return on those dollars. So, okay, let's increase your retirement income. Here's strategy number 1. Let's look at municipal bonds. We want to incentivize the listeners out here not to buy just individual issues. We want them to buy municipal bond funds. The reason being, you have greater diversification. With more diversification, you have less risk. It would be like having 100 stool legs underneath your stool. If one goes bad, that stool's pretty steady.
Right.
The easiest way to understand diversification. But if I buy one municipal bond itself, that's my one stool leg. So if something happens to that, I may crash down to the floor. Don't want that. I would rather have 100 legs underneath my stool, not just one. So that's diversification in the simplest sense. Here's one fund that we look at. The yield on a municipal is 4.54%. That's tax-free, 4.54%. In a 25% federal tax bracket, Chris, that's the equivalent of earning 6%, 6.05%. That's a 600% increase over just holding cash at a 0% rate of return.
Wow.
Pretty tremendous.
Yeah.
So, does it increase your risk? Yeah, it increases the risk more than what a CD is. CD is guaranteed by the FDIC insurance. But having that guarantee is costing you because you're basically going backwards very safely. Because, again, a 1% rate of return, you got to pay income taxes on that at 25%. So you're not really getting 1%. You're getting 70.75% of a return. So 3/4 of 1%, where inflation is 3%. So you're losing 2.25% purchasing power safely.
Yeah.
Well, you can't do that as a retiree. You should understand that. So that's where we help our clients understand that risk return. Taking this step into municipal bond fund is not that risky as long as there's, underlying due diligence on the fund itself, which we do. So we have that. But here's the other kicker. Year to date, and this is as of June 30th of 2012, the fund is up 7.89%. You say, okay, that's probably good enough. But then if you look up to August 31st, it's up 10.37%. That's incredible. Mm-hmm. But when you think about it, just based on the exit from the stock equity funds, mm-hmm. that money's got to go somewhere. Well, clients are moving towards less risky investments. So therefore, if more people are buying these more conservative investments, right. then that's going to bid up the underlying price. If the price goes up, mm-hmm. then we get a greater rate of return, and that's where that 10.3%. It's just in the numbers right here says, yes, there is a greater demand for this fund just based on the rate of return, because the underlying interest payments are not going to change in those bond funds. Those right. are set based on the term of the note in that bond. Mm-hmm. So the demand, it's showing true, because 7.89 from June and now August 31st, we're up to 10.37. People are bidding these up, so yeah. we're having a greater demand for these. So you say, okay, I want some of my money in municipals. What's the other strategy that I can do to increase my retirement income? But we're not going to Vegas like you did, Chris, and bet on red or black on the roulette wheel.
My whole $3.
Right. So we want to shift and move into preferreds. Basically, they get a preferred rate of return. They get paid first, and they're also up the liquidation ladder in case something happens to the company. Right. But again, we're not buying the individual preferred. We're buying a fund of preferreds. Mm-hmm. So the one that we look at yields 5.8%. That's taxable. Okay, that's real close to the 6.0% tax-free equivalent. Mm-hmm. Year to date, as of 10/05, this fund is up 15.5%. Now, again, all listeners, past performance is not indicative of future performance.
Exactly, yeah.
But, again, this is another safety asset class which we utilize with our retirees in our practice at estate management counselors. And this is one which we, a 5.8% yield on that investment. You put $100,000 here, that's close to $6,000. That's $500 a month. Mm-hmm. So that's one tool that we use, piece in the puzzle for retirement income planning. And, you got to ask yourself, are you holding the right investment in your right account? Now, as a listener, you may be driving down the road, heading to the grocery store, and you say, I don't know if I have the right investment in the right account. Mm-hmm. I know I have some investments, and that's where we ask the clients to bring in their account statements. We look at them, we review them, and you'd be surprised, Chris, how many people have the wrong investment in the wrong account.
Right.
They have high dividend paying stocks in brokerage accounts, and they're not spending that money. Mm-hmm. So they're paying tax on those dividends every year, and therefore their actual net rate of return has to go down based on the tax in which they're spending.
Right.
So we, take a look at that, and that's where, as a certified financial planner, we analyze that. And then as a CPA, we analyze and say, do you understand the real net rate of return? So we're actually licensed to give tax advice. Mm-hmm. And as a listener out there, it's the net spendable dollars that you have at the end of the day that really matters.
Right.
And, again, stockbrokers, the little fine print at the end of every statement, we're not licensed to give tax advice. Mm-hmm. Well, part of financial planning is making tax-efficient decisions with the portfolio. And that's the professional edge difference that we have at the estate management counselors.
Right.
And if that makes sense, to bring in your statements, put things together to get a second opinion, give Tina a call at the office, 877-654-9798. This is Scene Todd with the Professional Edge.
You got it. Stay with us. We'll have more of the show coming up.
Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Scene Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Scene is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Scene Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach estate management counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798. As a tax attorney CPA for over 15 years, Scene Todd has implemented over 1,000 individual estate plans. He has recently authored an especially helpful guide, How to Unlock the Ultimate Estate Plan. This guide has helped many individuals to understand the benefits of an estate plan and how to avoid unintended disasters. Scene has made every attempt to write this in plain English. To receive this valuable guide, How to Unlock the Ultimate Estate Plan, call 1-877-654-9798 and request your complimentary copy today, or by emailing your request to info@emcadvisors.net.
Welcome back to Professional Edge with Scene Todd. I'm Chris East. Thank you so much for taking out a little bit of time today to join us for the show. Lots of good information, and as always, if you want to get in touch with Scene, 877-654-9798, 877-654-9798. You can always check out the website, too, emcadvisors.com, and keep this email address handy, info@emcadvisors.net, because we'll be going to the email bag, answer a couple of questions coming up a little bit later on during the show, and we might have a little surprise for you.
All right.
Everybody likes free stuff.
We do.
Yes, we do. So I'll tell you how you can maybe get something free here in just a little bit.
All right, so stay tuned.
Sounds good, Scene.
All right, so let's jump back into investment strategies for these uncertain times. Here for our women listeners out there, if you are age 65, a woman can expect to live on average an additional 20 years. And like I said, sort of a recap of last week's program, we have longevity concerns when we do retirement investment advice in our practice, Chris. Mm-hmm. And this just sort of solidifies that. And it says, again, at age 65, women can expect to live on average an additional 20 years. In addition, many women will live into their 90s. That means that women should generally plan for a long retirement that will last at least 20 to 30 years. That's substantial, because now we can't assume that we're going to pass away within 10 years. And this is based on the U.S. Department of Health and Human Services, a 2010 study. So longevity risk is on the woman's side in their planning, because then they got to say, okay, the man passes away, what's going to happen to their resources?
Right.
And that's where we sit down and work with clients and say, if he passes away, part of his defined benefit pension would go away. We would only now get half of his pension, or it may totally evaporate. What's going to happen with the Social Security benefit, meaning wife doesn't get hers and his anymore? She may be able to elect to take the decedent's amount, which may be higher than what they have. But then our sustainable income sources are definitely affected, and that's where we utilize the software and terminate clients at different times, Chris.
Right.
And then we say, okay, you're only going to live 5 years. What's the scenario going to look like?
And I'm sure they like that.
Right. But, it gives us some real numbers to at least make some educated decisions and plan for that just in case happening. Or we may say, what's going to happen if you both live to age 95? So will this sustain itself? So that we got to make sure that the assets are going to be diversified enough, but yet not safe enough that they're not going to earn any rate of return. Because what unfortunately people think is day one of retirement, I got to have all my money in the bank in CDs and that's it, I'm done. Mm-hmm. Well, unfortunately, we know 1% CDs aren't going to generate enough retirement income to sustain a 20 or 30-year withdrawal period. So therefore, we got to have some in the safety bucket, we got to have some in a growth bucket, and then some more in a more long-term growth bucket. Not speculative, because, again, these are retirees that need to be conservators of their investment portfolio, not investors.
Right.
So that's sort of the theme that we're trying to get across this week is, as a retiree, you got to conserve your assets, not continue to try and get the next Apple, the next Home Depot that comes out of the gate, the next Oracle, things like that.
Mm-hmm.
So, again, what happens if the husband passes away? What are we going to do with the home? What are we going to have to do with health care costs? And then, are we going to have enough interest income and dividends to come in to sustain that if the pension portfolio goes away, meaning the defined benefit? A lot of people are hearing this 4% number, which says if you withdraw 4% of your assets, you should be able to live in retirement, sort of put it on autopilot. Mm-hmm. And unfortunately, a lot of people start reading Reader's Digest, the Money Magazine, and the other, Kiplinger and CNBC, and they hear this 4% number. So if I have $1 million, I take 4% of it, I spend $40,000 a year, I should not run out of money.
Right.
Well, unfortunately, that number is coming not true because of the sustainability of the income stream of that $1 million portfolio. Mm-hmm. So again, autopilot plans are not advisable to our listeners out there if you want some help on that. And, there is no magic number that you need to accumulate. You're seeing, some ads on what is your number.
Right.
Well, it's different for everybody because some people may have a defined benefit pension. Some people have more Social Security than others. It basically depends on what you as a listener are going to need in retirement. Mm-hmm. And we put together what's going to be needed: healthcare, real estate taxes, home costs, automobiles, insurance, things like that. And that's your number. Then we put that number and compare that against your portfolio and resources of income and see if there's a difference.
Right.
And that, again, is a individualized approach. It's not a blanket approach. So, definitely take the time, call Tina, schedule an appointment, and find out what it's going to take for you as a listener to have a successful retirement. And that way we can allocate and help you understand if you're short. If you're 50 years old as a listener, well, you still have time. You have 15 years, and you can make up a lot of headway on that. But if you wait until you're 65, 70 years old to try and figure out how much you need to get around and accumulate and save each month, well, time's too late.
Exactly.
So that's why, make that plan, because a lot of people, for some reason, spend more time planning their vacation than planning their retirement, which is amazing to me, dumbfounding, put it that way. So those are some of the things, if a spouse passes away, what's going to be the financial impact? If you're not sure, don't have a clue, that's why you got to give Tina a call to get a second opinion and just see what is going to transpire. That way you got a second set of eyes looking at what you're trying to do, and she can easily schedule a meeting, 877-654-9798. That number again, 877-654-9798. And let's go ahead and turn to some emails that we got in, Chris.
Sounds good.
All right, here's the first one from Alan. And it says, my CD matures in October. What should I do? The renewal rate is 1.07%. We know that inflation's running at 2.7%. So, Alan, if you want to lose money slowly, about 1.7%, go ahead and renew that CD. So, we would definitely recommend to take a look at some municipal bond funds that we talked about a little bit earlier. And those are definitely yielding a lot more than what a CD would. Are they riskier than a CD? Absolutely. They're not FDIC insured, but I think you're okay to step out on that ledge with the right municipal bond fund.
Great.
Then Diane writes in and she says, I never hear from my stockbroker, but you keep telling everyone to review their portfolio risk. What do I need to do this? What do I need to look at? Diane, that's why we offer a second opinion. You bring in your account statements. We look at it. If your stockbroker is not calling you, call us. Reach out.
On the stockbroker as well.
Right. Act with your own initiative. So call Tina, bring your account statements in. We review it, and then based on what you're trying to accomplish, being a fee-based advisor, we give you an objective recommendation. Mm-hmm. If it makes financial sense to you, then you get to decide who you want to work with. Continue working with your stockbroker or move over and work with a fee-based registered investment advisor.
Right.
So that way, that would be a lot different. Not hearing from somebody that's ridiculous, especially in this environment, because things are changing very quickly.
Mm-hmm.
Next one comes in from Sally. I am receiving my husband's Social Security. I'm worried that I will run out of money before I die. What is the best thing that I can do? Sally, here's the best thing you can do is, again, come in, put some information in front of us, how much Social Security you're getting, what your current investment allocation is, what your current investments are, your budget on what it's going to take you to sustain your current living, and therefore we can put that in and apply inflation to that to see how much it's going to be, whether it's sustainable or not. Mm-hmm. And that way we can get a better gauge on what it's going to be 10 years, 15, 20 years out to make sure that you're going to be okay. Because I would rather cut my expenses now $100 per month, mm-hmm. and that way know that I have a level of safety if that's what it takes.
Exactly, yeah.
And then Shelley writes in, how do I know if I'm being what is called tax efficient? Well, Shelley, bring in your 1040 tax return. Mm-hmm. As a CPA, I'll put that hat on, and we can look through and analyze whether we can add any real spendable dollars to your bank account instead of sending those to Washington, to the IRS. And that's what I mean by being tax efficient. That's having the right investments in the right account.
Right.
It makes a dramatic difference. And again, listeners out there, if you need a speaker at an event, be sure to give me a call or Tina a call. We can do anything from asset protection to tax efficient investment, or even a Swiss Army knife for retirement planning. Mm-hmm. This is Scene Todd here at the Professional Edge. Stay tuned. We have more to go.
Hey, before we do that,
yes,
got a little gift for you.
All right.
Everybody likes free stuff, including myself. How about this, Scene? We've got a copy of the book, The Big Retirement Risk.
Excellent read.
First 15 callers, we're going to give you a copy of that book absolutely free. All you have to do is just call. First 15 callers, The Big Retirement Risk. A copy of the book absolutely free just by calling 877-654-9798, 877-654-9798. Stay tuned. We'll have more of the show right after this.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Scene Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Scene, call his office at 877-654-9798. That's 877-654-9798. We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Scene Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Scene Todd help you implement an effective estate plan. Call 877-654-9798 today.
Welcome back to Professional Edge with Scene Todd. I'm Chris East. Always give us a call, 877-654-9798. 877-654-9798. You probably think that's the only line that I say during the show. And the reason why I say that, because all the other information I'm leaving to the expert.
There we go.
Seeing Todd.
Here we go.
Because I don't want to lead you down the wrong road. So I'm just going to give you the phone number, the website, the email address to get in touch with the professional at the Professional Edge.
I appreciate that, Chris.
All right, Sing, last segment of the show. Let's
continue on with investment strategies during these uncertain times. And here was a quote which pretty much says a lot of things. Problematic reluctance to sell because of loyalty to the company. I got to repeat that one more time.
Yeah.
Problematic reluctance to sell because of loyalty to the company. So where does that apply?
Yeah.
All right, let's look at it.
All right.
If we take and look at older clients that come in and we, again, time and time, we see too much risk in the portfolio and they have too much invested in the stock market. And they say, well, I've owned these stocks for forever. Again, problematic reluctance to sell stock. So they say, no, I can't afford to get out. And we say, well, let's see what the real numbers say. So we got to put on our CPA hat and our certified financial planner hat. And let's say the individual had invested $100,000 and through time it's grown to $200,000. And we run the numbers. It's long-term capital gains. Current rates are 15%. So if we sell out everything, we're going to pay a 15% long-term capital gain on $100,000. So we're going to have a long-term capital gains tax of $15,000 that we got to send off to the IRS. So we're going to have a net of $185,000, which is going to be out of the market. So now we're out. We are holding cash. But we know, as a listener, you're not going to hold cash for forever because it doesn't pay any rate of return. But if we compare that and we say the client stays in and they have their $200,000 investment and for some reason the stock market has a correction of 20%, then now their account value is $160,000. So that's a difference of $15,000. No, $25,000. So we compare, do you want $185,000 out of the market, cleaned up, no more tax on it? Or do you want to keep your $200,000 investment in the market, subject to market risk, and if the market corrects, it goes down to $160,000? So again, clients have too much risk, and again, running the numbers, we can cash that out. That's a $100,000 gain to remove that market risk. That's part of effective conservation of the portfolio for retirees. And then we look and say that might make a lot of sense because, again, the quote that we started off this whole session with is problematic reluctance to sell because of loyalty to a company.
Right.
So, they had a past winner. It's accumulated. Great. But if you can't secure those winnings, it doesn't matter. So let's cash it out, remove that market risk, and do a little bit more conservative going forward. And again, we talked about municipal bond fund. We're yielding about 6% tax equivalent. It's about 4.3%. That's pretty safe and secure. As a retiree, you want to conserve your assets, not be an investor in your entire portfolio. Chris, how many books we got left on the call-in?
Let's see, 5.
We have 5.
5 books.
All right,
How do
we get those books, Chris?
Pick up that phone, dial carefully, as I might add.
Okay.
877-654-9798. 877-654-9798. So start dialing. 5 books left, and they're going to go fast.
Okay.
If not, I'll take them. And I won't let you have them.
Back to the statement.
Exactly.
Problematic reluctance to sell because of loyalty to the company.
Yep.
Hometown favorite. Let's look at Aflac. Okay. It's currently yielding 2.8%. Pretty good yield on investments. $100,000 portfolio, $2,800 a year. It's okay. 5-year return, minus 1.31%. 5 years. Now, alternative fund, which is preferred stock, comparing the yield, 5.74%. Okay. 5-year return, 2.87%. positive. So you say, that's not that much difference. But let's look at the numbers, Chris. For our listeners, what does a difference of 4.17%, and again, per year matters? Because we went from minus 1.31% to a positive 2.8%. That difference is 4.1% per year because it's an annualized return. So the magic in the numbers, the same $200,000 would generate $8,000 per year. Okay?
Right.
So that's just not going to be $32,000, or it's not going to be $40,000. Okay? Because you got to remember it is 4.1% difference per year, and that's a compounded rate of return that you have to look at. So if we're in Aflac and we have the $200,000 minus 1.31 annualized 5 years, you're going to be at $187,000 roughly in the portfolio. So it's actually went down in value, where the same $200,000 would be at $8,000 per year, but it grows to $245,000. So that difference, Chris, is $58,000 over 5 years. $10,000 a year, roughly. Again, not concentrating on the hometown favorite.
Exactly.
Not emotionally tied. As an investment advisor, we're not tied emotionally to any company. The company's got to perform. So if we just look at this, in this example, a $200,000 Aflac investment over 5 years, you would have $187,000. Difference on alternative, $245,325. A $58,000 difference.
Wow.
And again, we go back to that statement of problematic reluctance to sell because of loyalty to the company. That becomes costly by owning the hometown favorite.
Exactly.
$58,000 over 5 years. That's significant value. That's spendable dollars. So as an independent registered investment advisor, we focus on investment strategies to maximize the client's portfolio.
Right.
We make the recommendations to the clients. Clients don't have to take the recommendations, Chris, but numbers like this make a client sit back, and you'd be shocked, Chris. We show clients these numbers. They say, okay, but I'm not selling Aflac. Not telling you, that as a listener you got to sell the Aflac, but these are real numbers that you have to consider what your investment portfolio is actually doing.
Right.
So, the same, actually the alternative fund is less risk because it's a preferred stock fund. It's multiple companies, not just one company. But again, the hometown favorite, people like Aflac. It's a great company. Just the historical performance over 5 years hasn't been that good. This last year, done pretty well. But historically, 5 years, not done very well. A $58,000 difference in our example.
Right.
So that's where we have clients come in, bring their portfolio statements in, let us give an objective review, analysis. We provide that to them, and then they get to make that decision on what they want to do going forward. Do they want to continue to manage their portfolio independently, or do they want to engage our services on a fee basis? And again, Chris, I got to renew the challenge to all the listeners out there. If you do not have your estate plan in place, you've got to give Tina a call to request how to unlock the ultimate estate plan. That's free to our listeners. The number to call Tina is 1-877-654-9798. That number again, 877-654-9798. And we work with individuals down here in the Columbus, Phoenix City area. We have our office there in Columbus at the Cunningham Center. Great location. And come in, see me, introduce yourself, bring your stuff. Not going to charge anything for the initial consultation.
Just want to help you out and get you on the right path, right?
Right, exactly. And you'd be surprised, Chris, clients bring in like their will, and we review it, and, that's my legal hat that I have on.
Yep.
And I say, you know what, there's nothing that you need to do. Everything's fine. It's okay. It's a second opinion, free of charge.
Sounds good. Get some good information. And then before we wrap it up here, phone number 877-654-9798. Don't forget the website, too, emcadvisors.com. And if you have a question, you want to email in your question, you can do that. info@emcadvisors.net. Scene, enjoyed it today.
Absolutely. And tune in next week because we are going to go beyond IRA fundamentals.
All right. Sounds good. Have a good week.
You too, Chris.
We've all thought about it. Everyone listening will need one. Not having one can cause untold heartache, family conflict escalating to the point of a lawsuit. One simple thing that avoids all that: an effective estate plan. As a practicing tax attorney, Sean Todd with Estate Management Counselors has completed over 1,000 estate plans during his 15 years of professional practice. He can help you implement an effective estate plan, coordinate your financial accounts, and make sure you have named the proper beneficiaries to maximize your tax savings. Call 877-654-9798 today and let tax attorney Sean Todd help you implement an effective estate plan. Call 877-654-9798 today. With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the professional edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798.